Greetings from your investment advisor, Scott Campbell, with my third quarter market update. While the rally continues, the U.S. stock market was up 8.2% for the third quarter of this year and is now up over 14% year to date. That's pretty spectacular considering the market was down over 5% in the first quarter. Bonds also produced positive returns in the third quarter. Short-term bonds were up 1.19% for the quarter and up 4.14% year to date. Intermediate-term bonds were up 1.51% in the quarter and up 5.36% year to date. Long-term bonds were up 3.16% for the quarter and up 6.64% year to date. Rate cuts are helping the bond markets. Performance of bonds has slowly and is hopefully returning to the normal long-term standard level. The stock market has been quite strong. The S&P 500 sets new record highs on most days the market closes higher. The rally is being driven in part by strong earnings expectations. Analysts expect roughly 9% year-over-year earnings growth for the S&P 500 this year. Earnings are the fuel for the stock market. Ultimately, earnings drive the performance of the stock market. Earnings are the net profits earned by public companies, so it makes perfect sense profits drive the stock market. Following the trend of the past few years, the Magnificent Seven and other large cap tech names are helping to push the rally. Valuations or stock prices are considered high by some measures. As always happens when a rally continues for an extended period, some analysts fear the market has peaked and we're due for a correction. No one knows for sure, but even if true, market corrections are buying opportunities. They pass quickly and the market moves higher from there. An update on the tariffs. Tariffs have brought in over $165 billion in revenue to the U.S. Treasury. That's actual money. Foreign companies have committed to invest trillions of dollars, starting and expanding operations here in the U.S. Tariffs have protected domestic industries. The steel industry, for example, has reduced imports while boosting domestic production. Trade deals are slowly being done. Some trading partners are very stubborn, but the U.S. is the most lucrative marketplace on the planet. We are the spenders. We have more money and a greater penchant for spending than any other economy on the planet. Foreign manufacturers need to sell in the U.S. to generate the revenue they need to be successful. Current inflation is about 3% right now. That's right about the long-term trend. Clearly, inflation has dropped since the current administration took over, but prices are still too high. Inflation is in check, and to date, tariffs have not brought about the widespread inflation the talking heads and the mainstream media told us were a certainty. Real GDP growth, that's the economy, is moderating. Q2 saw a strong rebound, which was revised upwards to 3.3% annualized. GDP contracted in Q1, and the consensus for Q3 is a slower pace of growth, which follows normal seasonal trends. The U.S. economy always slows during the summer months. Employment remains positive but slowing due to the normal summer slowness in the economy and the removal of illegal immigrants. However, the latter appears to be temporary. Data shows the percentage of U.S.-born workers here increasing. The Federal Reserve cut the base interest rate by 0.25%. Future rate cuts are expected and will help the economy and both stock and bond markets. The current federal government shutdown is having very little impact on the stock market. The markets have been through many of these and seen them come and go. They rarely last and are quickly forgotten once resolved. It is interesting to note that the Democrat Party is pushing to add back spending cut in the big, beautiful bill. I will remind everyone the federal government debt still remains over $37 trillion. This debt will crush future generations. Now, we head into the fourth quarter, which historically is one of the best quarters for the stock market because corporate earnings or profits, as we discussed earlier, are usually very good in the fourth quarter due to year-end and holiday spending. So, hopefully this fourth quarter is in line with many past fourth quarters. Please reach out if you have any questions or need any help at all. Thanks very much. Hope to talk soon.